$300,000 placed into a Vanguard S&P 500 index fund in January of 1995 is worth approximately $5.4 million today. No stock picks, no options, no leverage, no crypto. 30 years and a 10% average annual return, which is the actual verified historical average of the S&P 500 going back a century, confirmed by Robert Shiller's dataset at Yale. The person who did absolutely nothing beat 93% of actively managed funds over that same 30-year period. That's not my number, it's from S&P's SPIVA scorecard, which has been publishing this data every 6 months since 2002. So the question is not how to invest. The question is why most people set this up correctly, watch it work, and then burn it down. Here's what the title of this video actually means, and I want to be precise about the math before we go anywhere else. If you invest $800 a month for 30 years, your total contributions over that period are $288,000. Call it $300,000. At the historical S&P 500 average of 10%, you end up with somewhere between $1.8 and $2 million. You put in $300,000, you get back $2 million. That extra $1.7 million was generated by doing nothing. Your accumulated capital worked while you lived your life. But here is the part that most financial content won't tell you. The math only reaches that number if you stay out of the way. Most people don't. And there are 3 specific predictable failure modes that destroy this calculation, almost always in the same order, almost always for the same psychological reasons. That's what we're here to talk about. I want you to hold one image in your head for the entire length of this video, because I'm going to return to it repeatedly and it explains almost every mistake I've ever seen in long-term investing. Think about a second employee. For the first 10 to 15 years of your investing life, you are the only one showing up to work. You save, you contribute, you deposit. The account grows slowly, almost insultingly slowly. And if you're honest with yourself, it feels pointless. But somewhere around the $200,000 to $300,000 threshold, and this is a real inflection point in the math, not a metaphor, a second employee starts showing up alongside you. This one doesn't eat, doesn't call in sick, doesn't negotiate a raise, doesn't sleep. It compounds at the rate of your entire portfolio continuously around the clock. Your accumulated capital becomes a parallel income generator that costs you nothing to maintain. And here's the thing most people never viscerally understand. By year 25 of a 30-year period, this second employee is generating more money per year than you ever contributed, more than you, by a wide margin. Your $300,000 in contributions becomes secondary noise. The second employee is running the operation. Every mistake I've seen, and I've spent 10+ years running my own business, surrounded by accountants and fiscal lawyers who've shown me how wealth actually moves, comes down to one core error. People fire the second employee right before he was about to outwork them. Keep that image. I'm coming back to it throughout. In a few minutes, I'm going to show you a specific number from a research firm that has been measuring this problem for over 30 years. A number that quantifies exactly how much money the average American investor has voluntarily destroyed through entirely avoidable behavior. It's going to change how you see every market correction for the rest of your life. But first, I want to walk through the actual compounding math decade by decade, because most people think they understand this and they don't. Not the way it actually feels at each stage. You start at 30, $800 a month, 10% annual return. After 10 years, your balance is approximately $162,000. Think about that for a second. You've contributed $96,000 over a decade. The market added $66,000. You haven't even doubled your money in 10 years. Meanwhile, your friend who bought a rental property is talking about equity and appreciation and cash-on-cash returns. You feel like you're behind. You're not behind. You just haven't met the second employee yet. After 20 years, same $800 a month, same 10%, your balance is approximately $611,000. You've contributed $192,000. The market added $419,000, more than double your lifetime contributions, now generated by capital working in your absence. That's the second employee pulling his weight. Still not dramatic. Still not the number people brag about at dinner. After 30 years, $1.8 to $1.9 million. You contributed $288,000 total. The market generated over $1.5 million. And in that final decade alone, years 20 through 30, your portfolio grew by more than $1.2 million. In 10 years, that one decade generated more absolute wealth than the previous 2 decades combined. This is not a coincidence or a quirk of my specific example. This is the geometry of exponential growth. At year 20, you have $611,000, and 10% of $611,000 is $61,000 per year, just from existing. By year 25, your base has grown to roughly 1.1 million, and 10% of 1 million is $100,000 per year added without a single new contribution from you. The second employee is now earning more in a single year than your total annual salary when you started investing. His productivity increases in proportion to the portfolio size, which means the single most destructive thing you can do, mathematically, structurally, permanently, is interrupt this in the back half. There is a story I think about when I explain this. A retired school teacher in Indiana, this is a true account, that circulates in financial planning circles, who began contributing to a TIAA CREF retirement account in the late 70s. She wasn't a sophisticated investor. She didn't read finance books. She contributed a fixed percentage of her salary because her school district set it up that way, and she largely forgot it existed. During the crash of 2001, she didn't sell because she didn't check. During the financial crisis of 2008, same thing. When she finally reviewed the account in 2012, she had over $1.2 million on a public school teacher's salary spanning 35 years. The lesson here is not that she was disciplined. The lesson is that she accidentally avoided every one of the 3 failure modes I'm about to describe because she never emotionally engaged with the account enough to sabotage it. She didn't fire the second employee. She didn't even know his name. Most people don't have that kind of accidental emotional distance from their portfolios. They watch, they feel every down month. And when the market drops, which it will, every few years, sometimes severely, they make a decision that feels rational in the moment and costs them hundreds of thousands of dollars over the following decades. Now, this is where it gets really interesting. And I want you to pay close attention here, because this is the mechanism behind almost every retirement disappointment I've ever observed. You probably think the problem is the market, bear markets, recessions, bad years. You think volatility is the enemy of the 300,000 to 2 million math. But that's not the problem. The market has recovered from every single crash in its history. The Dow recovered from the Great Depression. It recovered from Black Monday. It recovered from 2001, from 2008, from the COVID crash of 2020. Every time. So you think the problem is the market. The problem is actually you, or more precisely, the version of you that exists at the moment of peak fear. Dalbar, a financial research firm, has been publishing their quantitative analysis of investor behavior every year since 1994. What they do is deceptively simple. They compare the actual annual return of the S&P 500 with the actual annual return that the average equity fund investor earned, not the fund's return, what investors captured after their buy and sell decisions. Over the 20-year period, ending in 2023, the S&P 500 returned approximately 10.2% annually. The average equity fund investor returned approximately 6.8% annually. That 3.4 percentage point gap is not fees, it's not inflation, it's behavioral timing, people buying after the market has run up and selling after it has fallen, doing the opposite of what works, consistently. For 30 straight years of data, 3.4% sounds manageable. So let me make it specific. $300,000 at 10.2% for 20 years, approximately $2,100,000. $300,000 at 6.8% for 20 years, approximately $1,100,000. The behavioral tax, the cost of making emotionally driven, seemingly rational decisions on perfectly good index funds, is $1 million on a $300,000 base. $1 million. Not lost to a collapsing company, not lost to fraud, not lost to a bad pick. Lost to the gap between what the market returned and what you actually captured, because you went to cash in February and bought back in October after the recovery was already priced in. Your second employee kept showing up every day. You kept sending him home at the worst possible moment, and then rehiring him right when his work was already done. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Here is the part that never makes it into a retirement calculator. You can understand everything. I just walked through the compounding curves, the behavioral tax, the second employee framework, and still have a retirement number that's 30 to 40% smaller than it should be, because the actual mechanics of exiting the accumulation phase are genuinely complex and almost nobody explains them with real numbers. I built something for exactly this problem. It's called The Exit Code, an 8-chapter digital book built on 50 years of actual retirement data, not conjecture, not anecdote, not motivational framing. The reason I built it is that when I started running serious retirement projections for my own situation, I kept hitting questions that no video, no advisor, and no book answered with a specific number. The 4% rule the assumption that you can withdraw 4% of your portfolio annually without running out of money has a failure rate that nobody discusses honestly, and is particularly dangerous for people retiring in their late 50s before Medicare eligibility. The Exit Code walks through a dynamic withdrawal method that adjusts to the conditions you actually retire into, rather than the historical average conditions Bengen's original research was built around. It also covers the lazy portfolio, the specific allocation that has historically outperformed active traders over 30-year windows, according to Vanguard's own long-term data, and translates all of this into a mathematical framework that gives you an actual exit date, not a vague aspiration. You can get it through the link in the description. It costs less than one dinner out. And every year, you delay running these specific numbers compounds against you in ways that are not abstract, they are calculable. Now I want to introduce someone who makes this tangible, because theoretical math is easy to dismiss and a specific situation is harder to ignore. I'm going to call him Marcus. He's not a real person. He's a composite of patterns I've observed repeated across a dozen different conversations over a decade of being around people who manage money for a living. Marcus is 42. He has $180,000 saved across a company, 401k, and a small brokerage account he opened during COVID when the market volatility made him feel like he needed to be more active. He's made consistent contributions, he's earned reasonable returns, and he is frustrated. He runs projections and thinks, at this rate, I'll have maybe $600,000 or $700,000 by 65. That feels inadequate. So he starts looking at alternatives, rental properties, individual stocks, sector funds, anything that might accelerate the timeline. Keep Marcus in the back of your mind, because where he's standing right now, 42, 180,000 saved, is actually a mathematically powerful position that he is at serious risk of misreading. And the thing that's quietly bleeding his portfolio right now has nothing to do with his asset selection. Before I get to Marcus's specific situation, let me show you why the next failure mode is the most insidious one, because it operates silently and the damage only becomes visible 30 years later. Now, you might think the fee problem has been solved. Index funds are cheap, Vanguard exists, Fidelity has zero expense ratio funds, and you're right, that awareness has improved. But here is what's still happening at scale, and I want to be precise about it. Morningstar's 2024 fund fee study found that the average expense ratio for an actively managed US equity mutual fund is approximately 1.0%. Many run between 1.2 and 1.5. If you are also using a financial advisor, which roughly 38% of American investors do, according to the Financial Planning Association, and that advisor charges the standard 1% of assets under management, your total annual cost is approaching 2% of your portfolio every year, regardless of whether the market goes up or down. Here's what that number does in practice. Marcus has $180,000 invested. Let's say he's an actively managed fund with a total annual cost expense ratio plus advisor fee of 1.5%. At 10% gross return, his net is 8.5%. Over 23 years until he's 65, that 180,000 grows to approximately $1.2 million. Now, the same 180,000 moved today into a Vanguard Total Stock Market Index Fund with an expense ratio of 0.03%. Net return, essentially 10%. Same 23 years. His balance, approximately $1.7 million. The cost of 1.47 percentage points in annual fees compounded over 23 years is $500,000. Not a rounding error, not a small inconvenience. $500,000 transferred from Marcus's retirement account to fund managers who, statistically, did not outperform the index. The second employee generated the wealth, and then a portion of the second employee's output was redirected to someone else. There's a specific flavor of irony in the 1% AUM model that I find genuinely amusing. The advisor charges you 1% annually to maintain a diversified portfolio. But the entire strategy is to not trade, not time the market, and not make behavioral decisions. They are charging you 1% per year to do the thing that requires the least human effort, which is to leave the second employee alone and let him work. I want to be clear. Financial advisors who provide tax planning, estate structure, insurance optimization, Social Security timing analysis, that's specialized, valuable work that is worth paying for. But if the primary service being offered is, I'll build you a diversified portfolio and rebalance it once a year, you are paying between $40,000 and $100,000 over a 30-year period for something Vanguard's website does in 4 clicks and $0. The tax structure problem sits right underneath the fee problem, and it hits differently depending on which account types you've been prioritizing. In a traditional 401k, you invest pre-tax dollars and pay ordinary income tax on every withdrawal in retirement. In a Roth 401k, you invest after-tax dollars and pay nothing on qualified withdrawals. The conventional advice is use traditional when you're in a high bracket now, Roth when you're in a lower bracket. Simple enough. What this framework systematically underestimates is the value of tax-free compounding in years 20 through 30, specifically in the window when the second employee is most productive. If Marcus has $180,000 in a Roth account at 42, and it grows to $1.7 million by 65, every dollar of that $1.7 million is his, free, clear. If that same $1.7 million sits in a traditional account, and Marcus is taking required minimum distributions that push him into the 22% federal bracket, which is entirely realistic at that balance level, he loses $374,000 in taxes on the back end. $374,000. Not a penalty for doing something wrong, a consequence of a structural decision made at 38 that nobody walked him through carefully. There's also the taxable brokerage account problem, which is where Marcus's COVID-era trading account lives. Every year, his funds generate dividends and short-term capital gains, which are taxed as ordinary income. Every year, he pays taxes on gains he hasn't even realized yet. This annual tax drag reduces his effective return from 10% to somewhere between 8 and 9%, depending on his bracket and his fund's turnover ratio. Over 23 years, the difference between 8.5% and 10% on $180,000 is approximately $500,000. Tax drag and fees together can easily cost Marcus $1 million in a portfolio he thought was performing well. The math from $300,000 to $2 million works, but it requires all of the compounding, not 70% of it. I find it genuinely funny in a mildly enraging way that the financial services industry has constructed a system where the instruments most effective at building long-term wealth are the cheapest and simplest ones, and yet the industry survives primarily by selling complexity as a premium service. The more complex the product, almost always, the higher the fee. The higher the fee, the less of the compounding reaches you. Amused disappointment is probably the right framing. Anger is too much energy. Now, the final failure mode. And this one catches people who did everything else right. Here's something I want you to sit with for a moment before I explain the mechanism. Imagine 2 investors, identical in every way, same amount saved at retirement, same portfolio allocation, same withdrawal rate, same average annual return over the course of their retirement. One of them runs out of money at year 17. The other dies at 90 with more than they started with. The only difference between these two people is when their worst 5 years of returns occurred. This is called sequence of returns risk, and understanding it changes the entire architecture of how you think about the accumulation phase we've been discussing. Here is the underlying mechanism. While you are accumulating, working, contributing, buying shares, a market crash is counterintuitively somewhat beneficial. You're purchasing shares at a discount. The second employee is acquiring more inventory at sale prices. A 25% crash when you have 200,000 invested and 30 years of contributions ahead is uncomfortable, but mathematically fine. The shares come back. You bought more of them cheaply. When you are in the withdrawal phase, retired, selling shares to fund living expenses, a 25% crash in your first year of retirement is potentially irreversible damage. Because you are now forced to sell shares at the bottom to pay rent and food, you are depleting the principal. You are reducing the second employee's workforce at exactly the moment he's most vulnerable. And those shares, once sold at the low, are gone permanently. They will not benefit from the recovery. Let me give you the specific numbers that make this real. 2 investors. Both retire at 65 with $1 million. Both withdraw $40,000 per year. The classic 4% rule. Investor A encounters a 30% portfolio decline in years 1 and 2 of retirement, then earns average returns thereafter. Investor B encounters the same 30% decline in years 23 and 24 near the end of his life, and average returns through the rest. Investor A runs out of money somewhere between year 14 and year 17. Investor B dies in his late 80s with over $800,000 still in the account. Same starting balance, same withdrawal rate, same lifetime average return, different sequence. William Bengen, who published the original 4% research in 1994 in the Journal of Financial Planning, actually built his framework around the historically worst sequences of returns, not average sequences. He was trying to find a withdrawal rate that survived the worst case scenarios. The financial media then stripped the caveats, called it a rule, and handed it to millions of retirees as a static target without explaining that it only holds in specific conditions. Your first decade of retirement is when the math is most fragile. The second employee can be dismantled faster in the withdrawal phase than he was built in the accumulation phase. The most effective hedge against sequence of returns risk is not a better investment. It's a cash buffer, roughly 1 to 2 years of living expenses in short-term, low-volatility assets built deliberately in the 3 to 5 years before retirement. If the market drops 30% in your first year of retirement and you have a 2-year cash buffer, you live off the buffer. You don't touch the portfolio. You let the second employee recover. You give the compounding engine time to re-accelerate before you start drawing on it again. This is a structural decision that must be made before retirement, not during it. Because the moment the market is already down 30% and you're panicking is the worst possible moment to be designing your withdrawal strategy. Which brings Marcus back into the story. Marcus at $180,000, eyeing alternatives because the trajectory feels too slow. Here is what he's not seeing. He has 23 years of accumulation ahead of him. Every bad year in that window is a discount. Every correction is cheaper shares. The dangerous sequence for Marcus isn't between now and 65. It's the window from 65 to 70, when one bad sequence with no buffer can unwind 23 years of disciplined compounding in a handful of forced selling decisions. His job right now isn't to go faster. His job is to not introduce complexity and fees and behavioral volatility into a system that already mathematically reaches his destination if he leaves it alone. The thing Marcus doesn't realize is that the frustration he's feeling at year 12, the sense that it's moving too slowly, is almost a design feature of compounding. The first 2 decades feel like nothing is happening. And then the third decade happens, and it's almost violent in how fast the numbers move. The reason most people don't make it is that they abandon the system during the boring decade, right before the interesting one begins. Now let me put a real scenario together, because I want you to be able to map this to your own situation with specific numbers rather than abstractions. 38-year-old woman, we'll call her Claire. She's been investing since 29. She currently has $220,000 in a Vanguard 401k, primarily index funds, expense ratio under 0.1% with a 3% employer match. She contributes 8% of a $95,000 salary, which is $7,600 a year from her, plus the employer match of $2,850 total going into the account each year, approximately $10,650. She's not maxing her contribution. The 401k limit in 2026 is $23,500, but she's consistent. She hasn't changed allocation in 3 years, and her costs are already low. If Claire does nothing except exactly what she's already doing, her $220,000 base at 10% grows to approximately $1.4 million by 65, based on the second employee working on the existing balance alone. Add her annual contributions of $10,650 compounded over 27 years, and that adds roughly $1.2 million more. Claire at 65 is looking at approximately $2.6 million if she changes nothing. $2.6 million on a $95,000 income. No inheritance, no windfall, no options trading. Now let's layer the failure modes over that baseline. If Claire experiences the behavioral tax earns 7% instead of 10, because she goes to cash twice over the next 27 years and misses the recoveries, her base grows to about 1 million. Her contributions add about 800,000, and she ends up near 1.8 million instead of 2.6. That's $800,000 lost to timing decisions on funds that performed perfectly. If she adds an advisor at 1% AUM plus slightly higher expense ratios, total drag 1.5%, she nets 8.5% instead of 10. Over 27 years, that costs her approximately $600,000 more. Now she's at 2 million instead of 2.6 million. Better than the behavioral scenario, but still $600,000 transferred to fee structures. If she does everything right through accumulation, but retires into a market that drops 28% in year one, and she starts pulling $104,000 a year at 4% without a buffer, her plan has a meaningful statistical probability of failing before she's 85, even though she did the hard work correctly for 27 years. She can hit 0, 1, 2, or all 3 of these failure modes. They are independent and they stack. Most people hit at least 2. Most people never run the specific numbers that would show them which failure mode they're most exposed to. The 2.6 million is not optimistic fiction. That's the actual math. And the path between here and there doesn't require Claire to do anything she's not already doing. It requires her to specifically not undo it. So where does this leave Marcus? 42, 180,000, feeling behind, looking at alternatives. What I'd tell Marcus and what I'd tell anyone standing in the same position is this. You are at the most boring and most mathematically critical moment of your entire investing life. You are in the year 12 to year 15 window, where the second employee is just becoming genuinely powerful, where the compounding curve is tilting from gradual to steep, where the next 10 years will generate more absolute wealth than your previous 12 years of contributions ever did. The worst thing you can do is introduce sector bets, higher cost funds, and behavioral volatility into this system right now. The alternatives Marcus is eyeing aren't necessarily bad, but they're not the bottleneck. The bottleneck is staying in the system long enough for the third decade to happen. 3 specific things, and I want to be precise. First, get your costs below 0.2% total. If you are in actively managed funds charging above 0.5%, calculate the specific dollar cost of those fees over your remaining time horizon using any compound interest calculator. The number will be large enough to motivate same-day action. Not this weekend, today. The opportunity cost of 1 more year of high fees is not hypothetical, it's calculable. Second, build what I think of as an interference calendar. Every time you feel the urge to change your allocation, sell, rotate sectors, go to cash, buy the hot thing, write it down, the date, the reason, the market level. Do not act on it for 72 hours. Research on behavioral finance, including work by Shlomo Benartzi and Richard Thaler on automatic enrollment, consistently shows that forced delay periods dramatically reduce panic-driven decisions. The urge to act always feels most rational at moments of peak fear. That's exactly when it's least rational. The calendar creates distance between the emotion and the action. Third, design your withdrawal strategy before you're 60. Sequence of returns risk is not a problem you can solve reactively. The buffer, 1 to 2 years of living expenses in short-term bonds or money market funds, needs to be deliberately built in the 3 to 5 years before your target retirement date. The 4% rule is a starting assumption, not a plan. And the difference between a static withdrawal rate and a dynamic one that adjusts down in down market years can mean the difference between a plan that lasts and one that doesn't. 300,000 in contributions, 2 million out. The math is real. It works across virtually every 30-year historical window in American market data going back a century. But it only reaches completion if the second employee is allowed to finish the job. Every panic sell fires him mid-shift. Every unnecessary fee redirects his paycheck. Every poorly timed withdrawal in early retirement reduces his workforce permanently. Lazy investing built more fortune than crypto memes. The people who figured that out were almost always the ones who were boring to talk to about money in their 40s and completely, quietly, embarrassingly wealthy by their 60s. The system does the work. Your only job is to not